Okay, so let's try this one more time. Welcome to my live stream session. If you're watching this on YouTube, Facebook, hopefully you guys can hear me. Before I even proceed, I want you, if you're watching this from Instagram Live, I want you to type one if you can hear me loud and clear. All right. If you're watching on YouTube and you can hear me, I want you to type one before I get started because I just had a little hiccups. I want to make sure that everybody is good. Perfect. Okay. So all right, I see a couple of ones. Fantastic. Excellent. Let's get it. Let's get it. Okay. So tonight, ladies and gentlemen, I'm going to be doing something that I've never done before. This is usually something that I do in a private, meaning that I have a group of people really on a weekly basis where I teach them the strategy on how to get out of debt and pay off their mortgage in 7 to 10 years. It sounds impossible, but it's actually true and realistic. So tonight, I'm using StreamYard, which is the very first time I've ever used this platform to stream on different platforms. So that way you guys can actually get this since a lot of you may or may not see my post when I post regarding my webinars. So tonight we're looking at, let's see, ad. So tonight I'm going to be talking about how do you pay off your mortgage in 10 years or less using the infinite banking concept. All right. This is a very unique strategy that people have been using for the last 40 years to get out of debt, meaning paying off student loans, credit cards, mortgages, and also as a means to build wealth. And you're going to see exactly how this works. Go through this presentation. Now, one of the things that I want you to understand is back in the 1900s, all right, in the early 1900s, the duration to pay off your mortgage was actually 3 to 5 years. That's right, it wasn't 30 years. It was 3 to 5 years for you to pay off your mortgage in the early 1900s. And obviously, things started to change. Then when you looked at the mid 1900s, it now became 15 years. Of course, today, most people now have 30-year mortgage. They're actually also now working on 40-year mortgage. So that means the longer you have to pay your mortgage, the more likely you're going to be indebted to the bank or the government for an extensive period of time, which is robbing you from actually putting yourself in a position to build wealth. All right. So what we're looking at tonight, let me get up my screen here. Okay. All right. So I'm using dual screen, so you might see me looking this way, but I'm actually still here with you guys. All right. Now, the first thing that we want to look at is how do most people pay their mortgage today, right? What is the primary method that people use to pay off their mortgage? Now, if you're like most Americans, the chances are that you finance your mortgage. Okay, you finance your mortgage. So what does that look like? It means that typically, if you know that you're going to be purchasing a house in the next, let's say, 6 months or a year, you start saving money ahead of time to be able to have substantial amount of money for down payment. All right. Now, unfortunately, this is the only type of savings that people save for during this time period, meaning that they're not saving for emergency fund. They're not saving for investing. Only one savings account that puts you in a position to get enough money for down payment. So we're talking maybe $20,000, $30,000, $40,000, depending on the size of your mortgage, depending on the size of home that you're looking for, and so many other factors. All right. Now, when you save for your mortgage, that doesn't necessarily mean you're good to go. The next thing you want to do is to now, look for a house that you want to purchase. All right. So you got your down payment. So let's say, for example, you have a down payment of $20,000. You're looking to purchase a house that's worth $300,000. Well, what do? Now you go out and look for this house that's worth $300,000. The next thing that now happens here is that when you now find a house, ideally, because you saved this $20,000 specifically for your mortgage, most people will now drain that account to use it as a down payment for their mortgage. Okay. That's what a lot of people do. They drain the savings to use it as a down payment for the mortgage. And then the very next thing that they do is that they now go out and secure a mortgage. Because just because you have a down payment of $20,000 does not necessarily mean that now you can go out and get a house. Because now you have a difference of $280,000. Now, in order to be able to get the house, now you need an institution. You need an institution that's going to fund you the money to be able to pay off your mortgage. Ideally, you either go, traditionally people go with, with the bank, right? You go to the bank and say, hey, I got this house for $300,000. My down payment is 20 and here's 280 that the bank will give you. Now, I want you to pay very close attention to this. When the banks commit to giving you $280,000, they're not giving it to you because they trust you that you will pay the money back over the course of 30 years. They give you that loan because they know that the house that you're actually purchasing is worth that $280,000 at minimum. That is why they do an appraisal, all right, to get the true value of the house. Do you know why they do that? They do that because if for whatever reason you're unable to keep up with the payment or you miss 4 consecutive payments, your house goes into foreclosure. So now they have to recoup their investment back because the banks are in the business of making money, not losing money. So you can see that they loan you $280,000, but your collateral is also $280 in the house. All right. That is how most people typically finance their home. Now, when you do that also, the only time you're able to, let me see, hold on one second here. Okay. The only time you're able to now benefit from this ordeal is either when you choose to sell the house and then access whatever equity you have in the home, or you choose to do a HELOC, right? Which some people, prefer to do occasionally. Now, this is the pathway for 99.9% of Americans when it comes to home ownership. Rarely would you see someone putting down $300,000 at once to pay off their mortgage because a lot of people are not built like that. All right. Now, here's where it gets interesting. Now, I need you to pay very close attention because this is how a lot of people getting robbed when it comes to wealth building. The moment you lock in that deal with the bank for that $280,000, at that moment, you automatically signed yourself up to pay for 2 mortgages at the same time. I want to repeat that. The moment you sign the ordeal, you sign your contract, all right, and you start making that mortgage payment, for the next 30 years, you're paying 2 separate mortgages. On the left-hand side, that is your mortgage. On the right-hand side, you are paying for a brand new mortgage or a house for the bank. The moment you understand this, it changes your whole psyche. That for the course of 30 years, while it sounds good to be a homeowner, but at the expense of what? What is the opportunity cost of you owning a home? And let me bust some of you guys' bubbles. If you're still paying a mortgage on your house, you're renting. You don't own the house, right? You're not the landlord. You don't own it. The bank owns the house. Why? Because if you miss a payment, 4 consecutive payments, that is when you truly find out who the true owner is. All right. The only time you become the owner is when you're completely 100% mortgage free. So you're not any better off. I'm not any better off than someone else who's renting an apartment. The only difference is that at the end of the day, we get to own the home if we stick to the plan. Now, let's look at what happens over time. All right. As you pay into this, let's assume that you have a mortgage right now, right? And these are just hypothetical scenario. You have a mortgage of $355,000. Okay. And you were caught up in the high interest rate and you're paying 6.75%, which is pretty normal these days. I actually spoke to a client a couple of weeks ago. He's closed his deal and he's at 7.75%. I mean, that is really bad. All right. So you got this deal for the next 30 years. So then what happens? Okay. In the next 30 years, if you stuck to this plan, you would have paid $473,000 in interest for the course of 30 years. Let me say that one more time. If you have a mortgage, let me make sure I'm okay. If you have a mortgage of $355,000, you can, whatever your number is, and you're paying 6.75%, based on this example, you would have paid twice as much as your original mortgage. What is not now? Let's look at the opportunity cost. What does that translate to? Because sometimes when you're investing in something, whether it's a mortgage, whether it's a brand new car, and you're paying for a period of time, there's an opportunity cost for doing that. All right. You're missing out something at the expense of that payment that's spread over the course of 30 years or 5 years. So let's say the $355,000 that's going towards your mortgage, you decided that you were going to take that money and invest it either in lump sum or invest it every month over the course of 30 years. What is the opportunity cost? What would that look like over the course of 30 years if you earned an average return of 8% in the market? All right. I know this might shock a lot of you guys because we don't think like this when we're investing into something, right? If you have $355,000 at once, or you're putting it into the market every single month, the same way you're paying your mortgage, in 30 years, that $355,000 would have yielded $3.4 million. All right. $3.4 million. That is the opportunity cost. All right. So in other words, this is what we're giving up to be able to purchase a house for the course of 30 years when it comes to mortgage. Now, the reality is you and I probably won't be able, well, I won't say you and I, most people, right? Most people probably won't be able to save up $355,000 to pay off their mortgage at once. So what we're truly looking at is, how do we reduce this interest rate? See, this is what's killing a lot of people. This is what's stealing your wealth, because the longer you pay your mortgage, the more likely you're going to remain in debt or, get stuck with this mortgage that's robbing you of, your true ability to create wealth. Now, let's look at it this way. What if we can slash this 473 by some, maybe $50,000, $70,000? Do you realize how much time it will save you when it comes to paying off your mortgage? Do you realize that you can now put yourself in a position to start investing and truly building wealth as you truly desire, right? These are things that a lot of people don't think about when it comes to, their total finances, when it comes to building wealth, opportunity costs. We are all paying opportunity or giving up something for the ability to build wealth. All right. Now let me go to this slide right here and look at some real numbers. All right. I want to show you, based on the 355,000 that we looked at. Let's actually plug that number in here. Okay. 355,000 at the rate of 6.75% over the course of 30 years. Now, that means every month, all right, you're going to be paying $2,300 every single month if you have a mortgage of $355,000 at this rate. What you need to pay attention to is the monthly interest rate. You're paying $2,300, but the monthly interest rate is almost $2,000. Now, let me simplify this and do the math for you. If you scroll all the way down and go and calculate the interest over the course of 10 years, right? From year 1 to year 10, and look at all the interest that you would have paid over that period of time, you would have paid, well, actually your total mortgage payment will be over $276,000. All right. Out of that $276,000, you would have paid $224,000 $24,000 in interest. I don't think you heard what I just said. In 10 years, you would have paid $276,000 in mortgage payment. But out of that 276, 224,000 is going towards interest. Do you wonder why the banks get richer? Do you wonder why the wealthy keep getting wealthy? Because they design systems in a way that favors the ultra wealthy. Right? Now, if you want to even make it more ridiculous, if you keep scrolling and go all the way, assuming you paid your mortgage till the end of the 17th year, right here. All right. If you would have paid that till the end of your 17th year, you would have paid in total over $400,000, by 430 something thousand dollars over the course of 17 years. Out of that amount, roughly about $350,000 and some change would have gone towards interest in 17 years. Now, just in case you might have missed what's happening here, that means in 17 years, you would have paid for the bank's mortgage for their house. Remember, I said earlier, whenever you have a mortgage, you're paying two mortgages. You're paying one for yourself and you're paying one for the banks. Unfortunately, most people finish paying off the bank's mortgage before they finish paying theirs. And that's the case we're looking at. That in 17 years, you would have paid enough money equivalent to the original loan in interest. God forbid you pass away and your family are not in a position to continue the mortgage payment. The banks will come for your house. They will sell the home. Not only have they made out on the interest you paid, now they're double dipping because now they're selling the house to even recoup some more money back and your family's left out of pockets. God forbid you lose your job or you become ill and you can't keep up with the mortgage payment. The bank will still come for their house because it is their investment. If you remember the slide that I showed you earlier, that it's all about having your house as a collateral. So if they're giving you X amount of dollars, it's because your house is worth X amount of dollars. So when they sell it, they get their money back. Either way, it's a win-win situation for the financial institutions. All right. So you have to think about these strategies on how can you put yourself in a position to win financially by not putting yourself in financial bondage, such as a mortgage over the course of 30 years. Having a home is a beautiful thing, right? It's a beautiful thing. But if there was a way for you to reduce the time frame that it costs you the time frame it costs you to pay off your mortgage, wouldn't you want to do it? Right? And it's not a new concept, right? It's not a new concept. And that's why I always tell people that it is difficult to build wealth when you are in debt and paying interest. It's very difficult because every time, like let's take your credit card, for example. If you have credit card debt and you're paying the minimum payment because that's all you can afford, right? You're being robbed. You're being robbed significantly of major wealth because of the interest that you're paying over time. Same thing with a mortgage payment, right? And that is why I remember Warren Buffett saying this one time, and it just made absolute sense. He said, if somebody asked him, what is the best investment he can advise anybody to do? And Warren said, the best investment is go and pay off your bad debt. Go and pay off your credit card debt. Go and pay off all these excessive debt you have. You know why? Because there is no investment that you can put money into in a year, for the most part, that will give you 18% return on your investment. That will give you 22%, 29% ROI on your investment. You know why he said that? He said that because that is what these institutions are charging people on credit cards, now on mortgage as high as 7.something%. So when you pay that off, you've automatically saved yourself 22% in interest that you're paying to these institutions. You have to be smart with how you use your money. You have to think strategically on how do you build wealth. And to build wealth, you have to find the quickest way to get yourself out of debt. All right. And that is where the infinite banking concept comes into play. All right. It is not a new strategy like I talked about earlier. It's something that for the last 40 years, people have been using this strategy, right? For the last 40 years. So the goal is to reduce the interest you're paying on your mortgage so you can pay it off and become debt free in 10 years or less. All right. I didn't say reduce the interest rate, reduce the interest that you are paying on your mortgage over the course of, I don't know, 10 years, whatever, 10 years. So that way you're able to accelerate paying off your mortgage faster. All right. That's the opportunity cost we're talking about. Okay. So that's the whole essence of the infinite banking concept. So what exactly is infinite banking concept? IBC, AKA becoming your own banker. All right. This was a strategy that was developed. It's a personal finance strategy that was developed decades ago by a gentleman named Nelson Nash. And I'm going to actually, where's the set? Right. Right. This was developed by a gentleman named Nelson Nash many years ago. The concept, right? It's not a product, right? It's a concept that if you use it well, it puts you in a position to accelerate paying off your debt. Now, a lot of you may or may not have seen or read this book. I want to encourage you. You can get this book on Amazon, Becoming Your Own Banker. All right. Unlocking the Infinite Banking Concept. It's a book that teaches this, that wealthy people have been using. Whether you're wealthy, you're not wealthy, people have been using this for decades, right? And it's talking about how do you put yourself in the position to create wealth while also paying off your debt at the same time. All right. So the system involves using a specially designed mutual whole life insurance contract to create your own personal banking system. All right. Now, I may or may not have lost a lot of you guys because you hear and see people talk about this all the time. The unfortunate part is that people who talk about these things have zero clue on how it actually works, right? And that is why it's so dangerous to depend or rely on social media for all your information, because you can have somebody who has zero clue about anything get online, create a 60 to 90-second video and misinform the entire masses. All right. It happens in politics. So whenever you're talking about finances, whenever you're talking about, understanding how money works or how something works, you have to do your research. You have to follow successful people who have been using that particular, system or strategy and find out how it truly works. All right. So the whole idea is being able to leverage the equity inside of the life insurance contract. So you call it equity. Some people call it cash value. Right? And using it to finance your mortgage, your financial expenses like your mortgage, your debts, funding your investments instead of relying on traditional banks. Like you are literally creating your own bank. And when I say creating your own bank, I mean being able to put money into the institution, have your money grow while at the same time being able to leverage the same money to pay off your debt in as little as 30 days as when it comes to accessing the money. All right. And I'm going to show you exactly how that works. All right. Now, I want you to pay attention to it because this is visual and it will explain, it will show you practically how this concept works and how you can use it for your own personal situation. Now, the first thing to realize is that whenever you're funding a life insurance contract, okay, it's not necessarily about the death benefit. All right. And especially when you talk about the infinite banking concept, we're not really concerned about the death benefit. It's part of the package. But as you can see here, right, the blue represents the death benefit because based on, the Internal Revenue Code, you do need to have life insurance in place to leverage this type of policy or this strategy. The green represents the equity that you've built up in the policy. All right. And I'm going to show you how to do that in a second. All right. Now, what people do is when you have built up enough equity in your policy through the growth compounding interest over time, you're able to leverage and borrow against that money to not invest or pay off your debt. Now, I want you to pay attention. You notice, all right, the borrowed funds from the insurance company does not reduce your actual equity, your cash value in your policy. The reason is because your money remains in your account. They only hold the portion that you're taking out as a loan as a collateral. So what does that mean? If you have $50,000 in your policy and you decided that you wanted to borrow $20,000, well, the insurance company will loan you 20 from their money while your 50 still remains intact. What does that mean? Even though 20,000 of your 50 is held as a collateral, but the entire 50 is still earning interest every single year. That is the concept, or if you've ever heard of the terminology uninterrupted compound interest, that's what that means. That means your money is not interrupted any point in time. It continues to earn money every single year, day in and day out. All right. So hopefully this making sense. And then as you pay down the collateral, right, as you pay down the debt, your ability to now take out more loans continues to increase. And as you can see, your cash value continues to grow and grow and grow indefinitely as long as the contract remains enforced. Okay. So let me actually show you something else to illustrate this. All right. Now, what you're looking at right now, if this makes sense to you, then you truly understand the true power of compounding interest. All right. A lot of you guys probably have money sitting in your bank accounts. I know people who have $50,000, $100,000 sitting in their bank account and they know absolutely nothing to do with it. They don't have a clue what to do with it. And the banks are taking their money and putting it into, tier one capital assets. What's in there? Cash value life insurance policies. The banks are taking customers' money, your money that's sitting in your account, and they're loaning it out to people who own businesses. They're loaning the money out to people who invest in real estate, right? And they're making the 5%, the 7%, as high as 22% on your money that's deposited in their institution, and you're not earning anything on it because they understand the importance of leverage. Now, please pay very close attention to what I'm about to show you because this is a game changer. All right. This is a game changer. Now, let's assume that compounding interest, this right here at the top, let's call this a Eubank. This is Eubank. All right. And in Eubank, or matter of fact, yeah, so Eubank is the insurance company. Okay. And you have $50,000 inside of Eubank. And then you decided that you wanted to take out a loan. All right. Please pay very close attention because if you get this, it's going to change the way you view money. You have $50,000 sitting inside of Eubank. And you call Eubank let's just say Eubank, and you say, you know what, I need to take out a loan of, for the sake of simplicity, let's just say $50,000. So you have $50,000 in Eubank and you want to take out a loan of $50,000. But guess what? Eubank tells you, you know what? I'm going to loan, or we are going to loan you the $50,000. But when we loan you this $50,000, we're not going to touch your money. We'll leave your money inside of your account and let it continue to build up. And we will loan you $50,000 out of our money while your money continues to grow. However, we're going to charge you a certain percentage on the money that we loan you. So looking at this example, your $50,000 is earning 5% inside of Eubank. Eubank loans you $50,000 and they're charging you 5%. But your $50,000 is a collateral, still earning money. Okay. Let me make sure everybody's still with me because I'm not seeing that you know what, the chat is hidden. Give me 1 second. All right. Okay. Give me 1 second, guys. I just want to make sure that everybody's good. All right. Is everybody still good? Because I've been shooting the breeze for like the last 24, last 20, 30 minutes. So I want to make sure that everybody's still with me. If you're still with me, type 1 or give me thumbs up so I know that we're good and I can keep moving. All right. If you're with me and you're following, just let me see some indications. Type 1 in the comment or give me some thumbs up so that way I can continue to move forward. All right, let's see. All right. All right. So perfect. I can see a couple of ones. I see thumbs up. So one question. So this only works for people with large sum of money saved. Nope, not at all. This works for anybody. I'm just giving you an example of how it works. So you can start with 5,000, you can start with 10,000, you can start with 2,000. Whatever you have, the whole idea is to be able to build something that you can ultimately leverage with. All right. So let me continue with this so that we can wrap it up soon, pretty soon. 50,000 in Eubank, they loan you 50,000 and keep your money as a collateral. Pay attention. Your money's earning 5% interest and they're charging 5% interest. This is a hypothetical scenario. Now, for a lot of you guys who are math geniuses, I didn't do too well in school. I know some of you guys will say, Deepo, this doesn't make sense. All right. I'm giving you the worst case scenarios, ladies and gentlemen. Worst case scenario that your money's earning 5 and they're charging you 5. Well, you said, Deepo, that doesn't make sense. They're charging me the same thing they're paying me. Well, that's where compounding interest is different from amortizing interest. Because you see, with compounding interest, your money never stops growing. With amortizing interest, you're only paying interest on the balance that is outstanding. So if they give you a loan for, let's say, the 50,000, your monthly payment is $944 that you got to pay them back. All right. Now, over the course of 5 years, assuming that you pay this amount for 5 years, you would have paid them $6,614 in interest. All right. So ultimately, you pay back $56,000 and some change. But do you realize because your money never left your account and you kept on earning uninterrupted compound interest, you would have had $64,000 just by simply borrowing money from the insurance company while your money continues to grow. This is like this easiest way. So when you ever hear people talk about becoming your own bank, this is what they're talking about. Understanding how compound interest works different from amortizing interest. So can you imagine right now for some of you guys who have liquid money, whether you're into real estate, I know people with crazy money in the real estate game and the money just sitting in a bank account. But can you imagine leveraging something like this where you're able to put money into it, borrow against it, and your money continues to grow, and you take that money and you put it into your real estate deal and still make money off on top of that? That is how wealthy people play the game. Like I said earlier, it's not about the insurance. It's not about the death benefit per se. The insurance contract is just a vehicle that allows you to execute what I'm telling you right now. All right. Now let me shock you a little bit more. Right. What if we say, you know what? You want to, instead of paying this 50,000 back in 5 years, why don't we pay back in 10 years? Like, what does that look like? Ladies and gentlemen, if you pay this $50,000 in 10 years, that reduces your payment to $530. All right. But do you see the difference between the interest? You would have paid $53,000 back to the insurance company, but because your money was inside that account, your 50,000 would have turned to $82,000. You cannot beat compound interest. It's the 8th wonder of the world. All right. That is how Warren Buffett became one of the wealthiest people in the world, compounding interest. Why? Because of time factor. And listen, ladies and gentlemen, I did this using the same percentage. Your money's earning 5%, they're charging you 5%. What if I change this to 6%? All right. What if I change this to 6%? It's a no-brainer. 40,000 in interest that your money would have earned, 13,000 that you would have paid back. The same money. All right. So you can see why I told you that this book right here, it's I mean, it's a must read by anybody who wants to understand how money works. All right. How to use the same dollar twice. And if you're a smart investor, you're into real estate, right? Or you're into e-commerce, or you run a business like myself, we fund our insurance contract. We borrow against it, put it back into our business, and then make money in our business, and then take that money and we put it back into the policy, because this is the banking system now. It's no longer the traditional bank. It's no longer Bank of America, Wells Fargo, Chase. Yes, we use those for transactional purposes, but we use the contract as a means to put our money in a position where it continues to grow day in and day out. All right. Now, I did 50,000. So for the gentleman, or for the person who was asking, do you need a lot of money? Well, what if you only did 5,000, right? It's still a no-brainer. $4,000 compared to $1,300. Worst case scenario situations. All right. Obviously, these are hypothetical scenarios, but showing you the power of compounded interest. So in a nutshell, this right here represents the insurance company, right? Where your money continues to grow. This right here represents the loan that they give you once you've built up enough capital, enough equity or cash value in your life insurance contract. And contrary to popular beliefs that you got to wait 10 years, you got to wait 5 years to access money, that's not true, right? Like we access money in 30 days or less when it's structured and funded properly. All right. And I'm going to show you how we now use that to accelerate paying off debt. Okay. Right. And remember, tonight is really about helping you to understand how to use this concept to pay off your mortgage and clear all your debt in 7 to 10 years. All right. For some people, depending on where you are, strategy, I use it for investment purposes. Okay. So things you should know when borrowing for investment opportunities against a life insurance policy. So when we say borrow for investment, you can replace that for paying off your mortgage. You can replace that with paying off your credit card debt. Right? We have a client right now. We just got approved with a contract. He's using his to pay off debt because he doesn't own a home. Got another client who's using his to pay off his mortgage. Right? So wherever you are in this situation, like, it works for you. So what you should know, you have, and I want you guys to pay attention because I'm educating you folks. I'm educating you folks out there so that when you come across people who put out false information and they don't know what they're talking about because they haven't read books, they haven't gone to, surrounded themselves with people who understand how money works, and they're speaking from their own narrow knowledge, then you can be well informed, all right, on how this thing works. Number one, you have guaranteed access to cash right from your policy loans. Number two, you're never asked for the purpose of the loan. It's none of their business. Like, I can log into my contract right now, pull out funds, in the next 2 to 3 days, the money's in my bank account. Like, nobody asked me questions. It's my own private banking system. All right. Your loans does not show up on the credit report. Why? Because you're getting it from the life insurance company because they have a collateral, right? You have non-structured payments. Let me explain what this means. Unlike traditional loans that you get from the bank, all right, where you take out the loan, 30 days later, 45 days later, you have to start paying that money back. Inside of a life insurance contract, you don't have a set date as to when to pay the money back. You decide when and how you want to start paying it back. So if you take out a loan today and you say, you know what, I'm going to start paying it back in 6 months, you can do that. If you want to start paying it back next month, you can do that. If you want to pay $200, $300, it's non-structured. That's what that means, right? Loans are collateralized against cash value. So this is another myth or misinformation that is out there that a lot of people will say, why do I have to borrow money from my money? It's my money. Why do I have to borrow it? You're not borrowing your money. It's not your money. Remember, in the compounding aspect, your money never leaves the account. It stays there throughout the whole time. The insurance company lends you money while your money's held as a collateral. So when you're paying the money back, you're not paying yourself back. You're paying the insurance company back because your money never left in the first place, right? It never left in the first place. That is why it says policy loans does not require you to drain the bank. Why? Because your money was there all along. If you guys go back to the previous slide at 50,000, like it never left, right? It never left. Your cash value continues to grow with or without a loan. What does that mean? That means whether you take out a loan, the policy grows. If you take out a loan, it grows. If you don't take out a loan, it grows. Either way, it grows. Please tell me, what else can you use? What other financial instrument can you use that allows you to do this, right? Your cash value continues to grow. Loan payments are made to the insurance company, not your policy. I just talked about that. Interest on loan payments may be deductible as investment expenses. Let me explain what this means. I am not a tax advisor. I'm not a CPA. I'm a businessman and I understand tax codes and tax laws. Some of them, the ones that pertain to me. I know that when you take out a loan from any institution and that loan accrues interest and you pay it back just like your mortgage and you pay it back, the interest that you pay on that loan can be deducted, is a deductible expense. So what does that mean? If you go back to the previous slide, the interest that you paid on the loan that you accessed, you can take that and deduct it on your taxes. Come on. So at the end of the day, it's like you're winning on every side. So if you want to know why wealthy people don't pay taxes and people get mad, like wealthy people that pay taxes more, they need to be blah, 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 and only poor people think that way. Only poor people think that the wealthy need to pay more in taxes. Why should they pay more in taxes? Because they're leveraging the same tax codes that are available to everybody. All right? The United States love entrepreneurs. They reward entrepreneurs and business owners. They give them favorable taxes. If you're an employee, unfortunately, if you make $400,000, $500,000, it doesn't matter how much money you make. You're going to be taxed heavily. You are an employee, right? So if you want to start understanding how to win, you got to figure out what are the tax loopholes, like legit taxes that gives you loopholes, right? And that's why I recommend, for those of you who may not know, go and study these. Tax code 101A, tax code 72E, tax code 7702. These are 3 tax codes in the Internal Revenue Code that governs life insurance contract. And that's why people are able to build wealth, meaning they can grow their money inside of these contracts and access that money 100% tax-free. I don't think you understand what I just said. You can put money inside of a contract, have that money grow, tax-free with no losses, meaning you're not exposed to any market volatility. And then when the money finishes growing, the government says you can take the money out tax-free. Please tell me, please, somebody please type in the chat, what else, what other financial instrument can you do that with? Roth IRA, yes, you can put money on the Roth and you get access to tax-free, yes, but there are limitations to it. You got to wait till 59.5, right? Your money is in the market, right? So it goes like this. I'm not an advisor. I don't advise people on what to do with their money. I share what I know from a financial standpoint, right? I share what I know from a financial standpoint. There are very few, if any, financial instruments that allows you to grow your money tax-free, access your money tax-free, and pass the money to the next generation 100% tax-free. 3 things. If you know of any, please let me know. I'm interested. I'm all about putting money into places where, the IRS said, well, Depot, you don't have to pay taxes on this. I didn't write the codes. It's in there, right? Go and look at the, executive bonus plan, section 162 in the IRS tax code, right? How executives in Fortune 500 companies leverage cash value life insurance contracts to grow their money and access that money tax free. Now, these guys, they're making donkey money. So they're not putting in $5,000. They are front loading these policies because they understand how the tax code work. These ain't by term investor different folks. Like that's not my folks. Like, you know what I mean? There are people who specialize in that, but wealthy people, like people who are truly wealthy, they understand how to use permanent life insurance contract to put them in the position to build wealth and pass on the wealth to the next generation tax-free. All right. Finally, in the event of death, your loan balance is subtracted from face amount. What does that mean? Well, Depot, what happens if I take out $30,000 and I don't pay it back? Well, nothing happens, right? Nothing happens. What happens is when you pass away, John Doe owes $30,000 plus the interest that he has accrued. Let's deduct the $30,000 from his death benefit. And whatever is left, they get paid out to the beneficiary. That's what happens. But what I always tell people is the idea behind the strategy is not to take out and not put back. Remember, it's about becoming your own banker. You're creating a banking system where your money, you're able to take out money, leverage the money for an investment, pay off debt, and then put it back. That's the whole concept, right? But truthfully, if you don't pay it back, then nothing happens, right? What will happen is they deduct it from your death benefit, and that's pretty much it. All right. So what I want to share with you guys next, I'm going to do this. I'm going to use 10 minutes to do this, and then we'll wrap it up. All right. This is going to be a game changer for a lot of you guys. So what I want to share with you is how does this work? Deepa, I understand this, this becoming your own bank. Now, I understand the compound interest, the amortizing interest. Now, how do I now use this to pay off my debt? What does that look like? All right. This is where a lot of our clients get excited because I'm going to show you practically what it looks like, right? Practically what this looks like. And to do that, I'm going to, let's see, let me stop sharing screen and I'm going to show you another screen of what this looks like. Hopefully you guys are getting value. So like I said, this is my first time using, this platform. Actually, let me do this. All right. So what I'm actually showing you guys, this is a real. All right, this is not what I wanted to show. Okay. So give me 1 second here. Hopefully you guys are getting value out of this. Once again, this is my first time using this thing. So hopefully I'm doing pretty good. All right, let me answer some of these questions before I go into this stuff. Lizzie said, can you keep taking from your loan policy without refunding the previous loan? Yes. So let's say you have that 50,000, right? And you took out 30,000 from it. You still got that 20,000 left in there that you're able to leverage, right? You just can't come back and say, I want $30,000 because you already have that locked as a collateral. Now, ideally, when you put the money in, you're able to access roughly about 80 to 85% of what you put in within 30 days. All right. That's typically how it works. So just to kind of set the right expectation. But what I showed you guys was mainly to just kind of show you the simplicity of it, that if you have 50,000 and you took out 50,000, that this is what would happen. But typically you take out 80 to 85%. All right. Any other questions? I'm getting ready to share my screen again to show you my last slide illustration, and then we'll wrap it up for the night. Okay. So, my throat is hurting. Okay. All right. So I'll be fine. All right. Okay, so this is where it gets real, and I want you guys to pay very close attention because this is a real life situation of what I did for one of our clients who just who's getting his life insurance contract set up. The mutual whole life, not any. It has to be a mutual whole life contract. All right. So what this software does is that it looks at your full picture. It looks at all your debts, your credit card, your mortgage, your car loan. It looks at your investments, your business, your job, everything. And then it gives us an outlook as to what's possible if you leverage the system. So we can see here Jesse Blackson, this is a fictitious name, but the numbers are real numbers of an actual client that we just work with, all right? But obviously we have to protect his information. So first thing, his mortgage. He has a mortgage that's outstanding, $151,000. Interest rate, 3.25%. And his interest plus principal is $805.94. Okay. So this is what he spent for his mortgage. Now we look at the consumer debt. These are all the debts that he has outstanding. All right. You can see Citibank, Chase, Discover, Security Plus, and Stream Financial. In this column are the total outstanding. So roughly about $52,000 and some change. These are the interest rates he's paying on these cards, right? This is the minimum payment, and this is the actual payment he's paying every single month. So what we're looking for here, so sorry, give me 1 second. So what we're looking for are loose money, because this program is not it's getting you to use the money you currently have. You're not spending any additional dollars. We're only looking for monies that you're directing somewhere and looking for how we can redirect it. All right. So right now, we look at Discover, his minimum payment is $135, but he spent $200 a month. So $65 extra. So the system says, well, don't pay that $65 anymore. Let's take that money and redirect it. So you can see right here, we redirected the $65. All right. And then that money's being added to this bucket right here. We come to the investment. So he has an old 401k with a previous employer of $149,000. We're not touching that. He has a Roth IRA, right? Same with Charles Schwab, a little over $8,000. But he's not putting any more money into these two, right? And then he has his TSP where he's putting $98. So what the system said, well, what if we redirected this $98.96 into this bucket right here? And then with the Roth, well, since it's for retirement purposes, why don't we redirect this money here, right? Because it's money that he's contributing, and put it into the life insurance contract as a lump sum, because you can also use it, some people, as a means of retirement supplement. All right. So it serves the same purpose. So what the system did was to take this $98, added it to this bucket, and then the $8,000 added it to this lump sum bucket. Okay. His income source, we're not touching anything from that. Now, we looked at his insurance policies. He has two policies right now. The first one, this is an IUL, Index Universal Life, with a company called Midland, paying $300 a month, and he has death benefit of over $511,000. Unfortunately, the person who designed his life insurance policy 5 years ago did not do a good job, meaning that it was a poorly designed policy. So now he's 43 years old, done put a lot of money into it, but little cash. So this right here, this is the cash value he has. If this was done properly, he should be seeing at least 4 to 5 times this amount. Okay, but that's not the case. He has a term policy with Primerica, great product, but he's not really interested in that anymore, right? Because it's going to lapse pretty soon. So the system says, well, why don't we take this $300, this $88, and put it into this bucket, and then add it to this, all right? And then the cash value, we put it in here as a lump sum, and then add it to this bucket. So now let me kind of show you how this is coming together. The monthly redirecting is coming from the money he's already spending anyways. This is not extra money. This money's coming out every month. We're only redirecting it into the life insurance contract. Excuse me. The lump sum is coming from the money he has allocated towards Roth, and also money coming from the cash value from his index universal life that's not performing well because it was poorly structured. So what the system does, the infinite banking concept, what this does is we say, well, what if we use this as a monthly premium payment for your mutual whole life contract? And then we take this $10,677 and we put it in as a lump sum to get the ball rolling to accelerate paying off your debt. What does that look like for your scenario? Well, let's look at the report. All right. Now, we've already ran the illustration, we've done the numbers, and then we've uploaded it into the software. Do you see this number right here? If he follows the plan, all right, he'll be debt-free in 8 years and 7 months. If he sticks with his current plan, if nothing changes in what he's doing right now, he'll be debt-free in 21 years and 11 months with his current plan. So the infinite banking plan gets him 8 years and 7 months. His plan gets him 21 years and 11 months. Now, I'm not a psychic, but common sense tells you that you go with the one that helps you to pay off your debt faster. All right. And how exactly does this work? So let's look at the comparison. All right. So we're getting ready to wrap up very, very shortly here. So you can see that the moment we start his insurance contract, so right now he's going through the underwriting process, okay? Going through the underwriting process. And now, once he qualifies, remember I said earlier that 30 days from you putting money in, you can start taking money out. So let's say by December, he starts taking money out. Immediately, this insurance contract goes into effect, put in the money, 30 days later, he takes out money. Do you see how much loan he can take out? He has cash value of $10,976, policy loan, instantly in 30 days, $8,600. And you know what he's doing with that money? He took that loan and he now used it to pay off Citi and use it to pay off Chase Bank instantly, just like that. But remember I said earlier, because his money is inside this account, this compounding account, it's not leaving it. It continues to grow. So pay attention to the cash value and pay attention to the policy loan. Every month, do you see what's happening? Cash value is increasing, policy loan is reducing. The reason is because every month he puts money, that $5 whatever, into the contract, a bulk of that is going towards the cash value, right? So what he's now doing is the same money he used to pay Citi and Chase, he's simply going to take that money and use it to offset the policy loan. See, he's just redirecting money, but all this while, because of the compounding impact, his money keeps growing in that particular account. So let's see what happens in year one. In year one, Discover's paid off under this plan. In his current plan, he's still in debt with Citi, Chase, and Discover. All right. In year two, let's see. In year two, Security Plus is paid off. Under his current plan, only Citi is paid off. All right. In year three, come on. I mean, look at this. Stream Financial is paid off in year three. All right. In year four, So in year 4, what's start to happen now is because he has a huge amount left on his mortgage, we allow the cash value to continue to build up, right? So you can see year 5 still building up, year 6 still building up, year 7, year 8, now he has enough money in the policy to not pay off the loan, to pay off the balance of the mortgage. All right. But guess what? Because it's the money continues to grow and he's continued funding it, guess what's happened to his cash value? Each year that goes by, it continues to grow. All right. Now, to simplify this, I'm going to show you the report. All right. And then I'll stop to answer any questions and I end it up for the night. Okay. So in his current plan, you can see here 21 years, 11 months. The debt action plan, 8 years and 7 months, were real numbers. All right, real numbers. The beauty of the whole life is that it's guaranteed dividends or interest every single year. All right, it's guaranteed. It's not based on fluctuating what the market does. This is guaranteed. This is what separates this from IUL. All right, IUL is used for being able to capture the gains of the market. So some years you get credited, some years you don't, depending on what the market does. But you still don't lose money. In the mutual whole life, like you're guaranteed that your money is growing every single year. All right. So typically, like clients will have the IUL from a long-term growth standpoint, and you're still able to access your cash value. And whole life, they utilize it for the liquidity because you're able to use money pretty quickly in this. So so this is your current plan, right? Like I said, and then this is the debt action plan. But here's the beauty of this. After he finished paying off his debt in 8 years and 7 months, in 20 years, his cash value would have grown to 361,000. In 30 years, 679,000. And in 40 years, $960,000 following this plan. All right. So, and then here's the last thing I'll show you guys. This actually shows you exactly when you're going to be taking out your policy loan to pay off your debt, right? It's not something that's random. It's like it's predictable. If you follow the plan, this is what's going to happen at the time frame it's going to show you to pay off your debt. Now, here's the reality. This is not a one size fit all. All right. One of our other clients, he's able to pay off his debt in, I think, 5 or 6 years. Some people is 11 years, depending on how much debt they're in and what their cash flow is looking like, right? What extra payments they have here and there, and how much more extra money they're looking to put into it to get, to help them accelerate paying off their debt. Okay. So hopefully this makes sense. I know I've spoken for quite a bit. Actually, my throat is starting to hurt. This is interesting. So I do want to give room for you guys to ask questions because I know I've been shooting for a while. Okay, so I see somebody said, I have an account. It's been 2 years now. When can I take out a loan? 2 years. Well, here's the question. What account do you have? And how was it, how was it structured? So whether it's whole life or whether it's IUL, everything boils down to how it's structured. It doesn't matter how much money you pay in a month, right? Was it structured for, cash value accumulation? That's number one. Number two, did you max fund it? So max funding means outside of your, let's say maybe $300 a month, $500 a month, you put in extra 10,000. Okay. Those are the factors that determines how you're able to access money from these policies. So I can't necessarily give you an answer because I don't know what your situation looks like and if you're actually, funding it the right way. All right. Let's see. All right. So here's what I'm going to do because I have to get ready to wrap this up. If you are, so for those of you, can you access all your money generated from the cash value? No, typically, well, yes and no. Oof. Yes and no, but ideally, you're able to access 80 to 85% of the money in there because you never want to just borrow against everything that's inside your cash value. Right. Over time, you can do that, but it's not recommended. Right. Which is the best one to have? So there is no, I mean, it's not really like which one is the best one to have. It all depends on what your strategy is. Personally, I have one, two, three, I think I have like 4 or 5 IUL policies, and I have one whole life, right? So my index universal life policies for me is more of like that long term play. I can max fund it, let my money continue to grow, and not really worry about it. But if I need to, I can pull money out of it as well. But my whole life is more for that liquidity, right? Because I invest, I have other businesses as well. So I want to be able to put money in and then within 30 days take money out to, invest in other things. So it really depends on what you're trying to do. Like I said, we have a lot of clients now who are starting to look at this more from liquidity standpoint and leveraging it to accelerate them paying off their debt within a short period of time. So hopefully that helps. All right, cool. Lizzie said, just want to know out of curiosity. Perfect. Bucola said $200 a month and it's a whole life policy, I think. So you saying I think already tells me that you're not sure, right? Number one, if it's not a mutual whole life, the chances are you don't have that liquidity. If it's like a State Farm and all these other whole life, traditional whole life, you can't do this with that, right? You can't do this with that. So you'll need to reach out to the agent that you were working with to assist you with that. So here's what I'll do. For those of you guys, I normally don't do this, but I just do it tonight and see what happens. So for those of you guys who want to learn how this works for your situation, like, how does this work for your finances, right? Based on your mortgage, your debt, and all that kind of good stuff. And you want to see how long would it take you to get out of debt if you use this strategy. I'm going to put my number in the group just because it's not a whole lot of people live right now. So I'm not really too concerned. Don't call me. Shoot me a text message. That's the quickest way for me to respond, right? So I'll put my number in the group. Shoot me a text message, and I would set up a time with you. Look at my calendar to see what we can put together in helping you to come up with a situation that will help you. All right. So I just dropped my okay. Oh, so it's an IU. So you definitely have an IUL policy, right? So I would need to look at what your, how long you've had it and how your policy was structured when we first did it. Right. So all of that would determine what you have built up and what you can access. But what you have is not this. That is certain. You do not have, I can certainly tell you that. Okay. All right. So let me see if I can pin this. All right. So I just pin my number. Shoot me a text message. I will probably get back to you tomorrow if I have the time to schedule something. Then I can send you a document where you can fill in all your expenses, your liabilities, your assets, and then we can see what we can put together to help you make this a reality if it's something that you can qualify for. Because unfortunately, we've had people who unfortunately couldn't qualify for it. Due to number one, because life insurance, your health, involves your health, right? And number two, just financially speaking, it wasn't built for them, right? So, once we plug in all the information, the software will let us know if it's something you can qualify for, even move forward with, and then also the health situation. From getting approval standpoint, I mean, we've had clients take as long as 4 months because it's not, I mean, it's a very thorough process. Everybody can't and everybody won't qualify for this. All right. So yes, I will make sure that I save this video, and my pleasure, lovely lady, for your comment. So guys, that's all I have for you tonight. Hopefully you've been able to learn something that you didn't know before, and you know, the difference between compounded interest and how to make that work in your favor to build wealth and pay off your debt in as little as 10 years. All right. So with that being said, ladies and gentlemen, have a great night, and I'll see you in my next live video.